Good evening. All of you, please come to AS2. There is a query from a student that in yesterday's problem, this was the question I had given. Normal capacity is given in hours, actual is hours. So we have to write down one assumption in this question. What is assumption we will write down? Simply you just write one assumption. Time required for one unit is 1 hour. Time required for one unit is 1 hour, and then your doubt will be resolved. Time required for one unit is 1 hour. If time required for one unit is 1 hour, which means there is 10,000 unit full capacity, 7,500 normal capacity, and 6,500 actual capacity. So please write down this assumption at the end of the answer. Time required for one unit is 1 hour. Time required for one unit is 1 hour. Time required for one unit is 1 hour. Question was little poorly drafted, but then this is how the answer has to be understood. Have you noted the answer? Time required for one unit is 1 hour. So now we will continue with AS2. Let us see whether we can complete it or not by the end of today's lecture. And once we are able to complete, we can start some new chapter. Don't worry. Okay. So only ask relevant question relating to AS2. That will be replied. Other questions will not be replied. So today's topic is AS2. We will take some more important questions. Some more discussion will happen. And then we'll see your intelligence in full public view today. Okay. How much intelligent you think yourself today will be demonstrated in full public view, in public platform. So come to paragraph number 10. What is our topic right now? AS2. Under AS2, we are learning how to calculate the cost of inventory. We have learned cost of inventory will include your material, direct labor, direct expense, production overhead, and other cost. Production overhead will include variable overhead, fixed overhead, material, labor, direct expense. This we have discussed. Production overhead also we have discussed with few examples also. And now a small part is pending, and that is other cost. Other cost will be included only when they are incurred to bring the inventory to its present location and condition. If they are necessary to bring the inventory to its present location and condition, then the other cost will also be included in the cost of inventory. So other costs para 10 are included in the cost of inventory only to the extent, underline, only to the extent they are incurred in bringing the inventory to their present location and condition. I had given you some homework. First tell me, have you done? I had given you question number 1 as homework. Have you done? Honestly, have you done? So now you are not replying. Anyway, today you will solve all questions in the notes, okay? What about interest and other borrowing cost? The example here could be higher charges of machine, higher charges of machine, design charges, molds, 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 okay? Molds. So in that case, these will also be included in the inventory valuation. Now the next $1,000,000 question is, what about interest and other borrowing cost? What about interest and other borrowing cost? Interest and other borrowing cost is, there is a accounting standard 16 called borrowing cost, which we are going to take very soon in the near future only, because that is also a part of your syllabus. AS 16 deals with borrowing cost. If AS 16 permits, then add it to inventory cost. If AS 16 does not permit, then do not include. Then do not include. So for the timing, only write this much. Then you will ask me, when will AS 16 permit? When will AS 16 not permit? So the answer for that question would be that when we will come to AS 16, I will tell you. Right now we will not divert your attention from AS2 to AS16. Only relevant information is that the capitalization or the treatment of borrowing cost is now covered by accounting standard 16 on borrowing cost. So that will be considered. Is it right? So that will be considered. So I hope you have noted. Question number 2 printed in your book. Can interest on custom duty be included in the valuation of inventory? Can interest on custom duty be included in the value of inventory? Yes, please answer. Can interest on custom duty be included in the valuation of inventory? What is custom duty? When you import goods, then the government will levy custom duty. Then what is interest? If you delay in payment of custom duty, they will charge you interest. Now that interest is not related to inventory. That interest is not related to bringing the inventory in its present location and condition. That interest is a kind of penalty you are paying to the government because of delayed duty payment. Therefore, the answer is no. The answer is no. Interest on custom duty should not be included in inventory valuation. Now, next paragraph is question number 13. So, all of you please come to your booklet, and after few pages, you will find question number 13. So, please keep answering. Okay, then it will be an interactive session. All of you will participate. Question number 13. Don't read the answer if the answer is printed in your book. Asia Biscuit Limited has a normal capacity of 6,000 ton. This is normal capacity, and the fixed annual overheads are 24,000. During the year, it manufactured only 5500 at a variable cost consisting of material and labor at 6 and 4 per ton. At the end of the year, it has 1800 tons. So this is your closing stock of inventory. Find the value. So first chance will be given to you. This person is an student. He has to answer. Okay. He has to answer. The person on the right side is you only. You are only tensed, under stress by looking at the question. So when this person will come in, stress will come on you. So please reply. What will be the value of inventory? Time allowed 10 second. Time allowed 10 second only. Come on. Come on, India. Anybody wants to reply? What will be the value of inventory? Nobody wants to reply. I will only try. First, we will calculate cost per unit. Cost per unit, first you calculate. Material is 6 rupees. Labor is 4 rupees per unit. And fixed overhead is 24,000 divided by higher figure, normal capacity, divide by normal capacity. So 24,000 divided by 6,000 if I do, I get 4. So my cost per unit is 14 rupees. We have 1800 units in the closing stock. So 1800 into 14 rupees per unit, you will get 25,200 rupees. Oh, wonderful, Tanya. Saurabh Chauhan, Falak, Sakshi, Kunal, you are right. I hope you have not seen the answer. So let us come to our answer. Check the answer. If it is printed, then tell me. This is the answer. This is the presentation aspect. Okay, done? All of you say yes. So that was a small warm up question. Oh, the student has come again. Let us call him Kunal. Okay. Blue Lagoon Limited produces a consumer durable whose cost of production consists of all variable element 240 per unit. So 240 is this cost. The total annual production overheads are 25 lakh, out of which 40% are fixed. So it means I have to add variable overhead and fixed overhead. This variable element is only, you can say, prime cost. Prime cost. Direct material, direct labor, direct expense. And 25 lakh rupees is your total production overhead, 40% is fixed. So fixed production overhead will be 40% of 25 lakh, 10 lakh, and variable will be 15 lakh total. Company has a normal capacity of 10 lakh. This is normal, but during the year it produced 20 lakh unit. As far as variable is concerned, we will take actual. And in case of fixed, actual or normal whichever is higher, actual or normal whichever is higher. So I am going to take actual here. Logic I have explained. Otherwise it will result into over absorption of overhead. More overhead you will consider rather than other than what you have incurred. So this is my per unit variable overhead. This is my per unit fixed overhead. Now 1 lakh units are still unsold. Oh, so you have to find the value of 1 lakh unit. First chance will be given to the student. Student will tell me final answer. What is the final answer? This is question number 16 in your book. Final answer, you will tell me what will be the value of your closing stock in this question number 16. 240 is prime cost. Variable cost per unit is 15 lakh divided by 20 lakh. 0.75. Done. Those who have done, give me the answer. 10 lakh divided by 20 lakh. Fixed overhead is 0.50. So total comes to 241.25 per unit. 241.25 per unit. 241.25 into 1 lakh. So that will come to 2 crore 41 lakh 25,000. That will come to 2 crore 41 lakh 25,000. Is the answer right? Say yes. 2 crore 41 lakh 25,000. So the answer should be presented like this on the screen. The answer will be presented like this. Variable cost. Now this you write down here. Variable cost is material plus direct labor plus direct expense. Sometimes the student will harass me. They will say, can we assume variable overhead is also included here? Unnecessarily do not complicate. Pawan Kalyan is right. And then you will take the cost per unit, multiply by quantity, and you'll get the value of the closing stock. Okay? So we will assume that variable overhead is not a part of variable cost. You can just mention here, note, variable overhead, otherwise you will harass me unnecessarily. Variable overhead is not included in variable cost of rupees 240, is not included in the variable cost of rupees 240. Okay? Variable overhead is not included in the variable cost of rupees 240. These are some basic question to start with. Now we'll come to one question number 26. Kindly come to one question number 26 printed in your book. Question number 26 you will find in your book. State with reference to accounting standard. State with reference to accounting standard, how will you value the inventory in the following case? How will you value the inventory in the following case? Per kilogram of finished goods consisting of material. Oh my God, material is 100. Direct labor 20. Direct variable production overhead 10. Fixed production charges for the year on normal capacity of 1 lakh kg is rupees 10 lakh. So fixed overhead is 10 lakh and divide by 1 lakh normal capacity. So that comes to 10 rupees. So the total comes to 120, 130, 140. Closing stock is 2000 kgs into 140. Check the answer in your book. Is it 2 lakh 80,000? Please reply. Is it 2 lakh 80,000? Everybody. 2 lakh 80,000. This question is over. Very easy problem. Do not expect such question in the exam. Okay. What institute have done in the presentation, they have multiplied each number by 2000 kg and they have got 2 lakh 80,000. So this is right. Yes, Sanket, you are right. One more we will practice. Please come to question number 18. 1 8 18. Question number 18. So, what I am going to do today, we are going to discuss the concept and will take related question. Few question we will take in class, and whatever I cannot take, you will revise yourself as homework. Because of the time limitation, we cannot take all question, otherwise one chapter will take 10 days. Okay. Once I have done my duty of explaining concept, the student will have to only practice. So question number 18 in front of you. Okay, please practice all question. I have assembled from many sources. You don't have to read multiple books now. CAP Products Limited has an annual capacity of 40,000 unit. Fixed production overhead. The production overhead for there is estimated to be 3,20,000, whereas the total variable cost incurred is 6,90,000. So variable cost means other than overhead 690, and this production overhead is 3,20,000. Production overhead is 3,20,000. The administrative cost and selling cost are given. Now this is given to confuse you. To confuse. Okay. We will not include administrative cost and selling cost. Only if the problem clearly says that administrative cost relates to bringing the inventory to its present location and condition, we as a student will not include administrative and selling cost in inventory valuation. So this is given to confuse a pre-confused student. At the end of the year, there are 6,000 units in the stock. There are 6,000 units in the stock. Find out the value of inventory. In this question, normal capacity, actual capacity is not separately given. So whatever is given is only one figure, 40,000. So therefore we have to work with 40,000 unit only. So you can't make mistake even if you want. Given that factory remained closed for 1 month for non-receipt of order, which is a normal practice. Is it right? Again, it does not affect the answer. Even if the factory remained closed for 1 week, which is a normal practice, it does not affect my answer. So let us solve this question. My total cost is 6,90,000 plus 3,20,000, 10,10,000, and the quantity is given 40,000. Assume normal and actual capacity are same. Now, unnecessarily don't take tension. There is only one quantity. Take this quantity as actual, this same quantity as normal. So you will get cost per unit. 10,10,000 divided by 40,000, 25.25, and somewhere below 6,000 units are in closing stock. So therefore value of the closing stock will be, multiply this two figure, 1,51,500. Very good, Sanket, Pavan, Kunal, etc. Okay. So this is 151,500, and in the exam you will write some notes which I have given in your book also. One note you will write here, that administration and selling cost should not be included in the inventory valuation as per AS2. It's given. Storage cost, administration cost, selling and distribution cost, abnormal material, abnormal labor, etc. will not be included. And one more note you will write, that as per AS2, the allocation of overhead is not affected by the abnormal reasons such as closures due to non-receipt of order. Hence, the value of the inventory will remain the same. Hence, the value of the inventory will remain the same. Value of the inventory will remain the same. Today, we'll understand one more thing, and that is called cost formula. So, your next paragraph number 11, it is heading should be cost formula. What are the three cost formula? What are the three cost formula as per AS2? What are the three cost formula as per AS2? Anybody, any answer? What are the three cost formula as per AS2? So AS2 says cost can be calculated by using one of the following three formulae. And these formulae are: one is called specific identification method, which I am going to write as SIM. Specific identification method SIM, and FIFO, first in first out, weighted average. This I will call GIM. SIM GIM. What is GIM? General identification method. SIM GIM, general identification method. Now, when will you apply SIM? SIM can be applied only in limited situation. SIM can be applied. Oh, who is this lady? SIM can be applied only in limited cases. Okay, when you can directly link the cost with specific item of inventory. SIM means specific identification method can be applied only when the cost can be traced to the specific item of inventory. Here the inventory is jewelry, okay, not that lady. SIM GIM. Suppose this is a designer car. This is a designer car. I have got it designed for me. I have asked one company, DC and company, that please design for me only this car. Okay, it is not manufactured by Tata Motors or Maruti, Suzuki or Hyundai. This is designed for me. Okay, it can fly also. It can swim also on river. Okay, it can land on any surface. And it doesn't have driver also, but designed for me. So what this DCN company will do? DCN company will maintain a job card. DCN company will maintain a job card, and all the cost they are going to incur in manufacturing this car, they are going to allot to this car only. They are going to allot to this car only. Okay, so there may be some other customer also. Other customer wants some other car designed for him with some different feature. So suppose Salman Khan also goes. Salman Khan says to DC, design one car for me also. He will open one more job card number 2, and all costs incurred for car which is to be delivered to Salman Khan will be separately valued. So now you have understood. Now you have understood that this method can be used only in certain industry where the goods are manufactured as per the specific requirement of a customer. Second thing, goods cannot be interchanged. My car cannot be given to Salman Khan and vice versa. Salman Khan's car cannot be given to me. Goods should not be interchangeable. Specific item of inventory is meant for a specific customer only. Is it right? Or for example, jewelers who make customized jewelry. So Juhi Chawla goes and she says, please make a uh, whatever necklace for me. After some time, Alia Bhatt also goes. Alia Bhatt says, please make a necklace for me also. Then after some time, Tapsi also goes. Tapsi also says, make one necklace for me. What this jeweler will do, it will give them some kind of identification tag. All cost incurred will be separately calculated for Tapsi, Alia, Juhi. Okay. In such industry, you can follow SIM, specific identification method. So when can you apply specific identification method? When in case of purchase of item that are segregated for a specific project and not ordinarily interchangeable between the projects. Okay, so the goods for one customer cannot be interchanged with other customer. I gave you example of a designer car. I gave you example of jewelry. And in case of goods and service produced are segregated for a specific project. So the companies should be able to identify separate cost for each project. If it is possible, then you can apply specific identification method. Then calculation of cost is easy. Whatever cost which goes into production or manufacturing of one particular item will be added to that inventory item. So which kind of industry follows this method? You will learn in your costing job cost industry, like furniture makers who manufacture customized furniture, tailors, okay, jewelry manufacturer, designer bike, designer car, okay, such industry can follow this specific identification method. Now quickly answer. This is a Casio company. This calculator you may also be using. Yes or no? All hundreds of you sitting here, you are also using Casio calculator. Can this Casio calculator company use specific identification method? Come on. The answer is no. Casio calculator company cannot use specific identification method because they manufacture in large quantity and goods are interchangeable. The moment a customer goes, they will pick up from the shelf and give it to you. So it doesn't matter who comes first or who comes later. So you cannot follow this. Is it right? Company which is manufacturing this pen, can it apply specific identification method? Yes, Shankar Mahamuni. No. Tanya, no. Sakshi, no. Sanket, no. So you are right. Pavan, no. Kalyan, no. First in, first out. Another method to calculate cost is FIFO, first in, first out. This method assumes that, assumption, it only assumes that the item of inventory which were purchased or produced first are consumed or sold first. Item which are purchased or manufactured first will be sold first. So if you have opening stock, purchase, purchase, sale, sale, let us say opening 100, purchased 200, then purchased 300, sold 250, sold 50. So how will they go out? First, this 250, you deduct 100 from here and 150 from here. Then this 50 will be deducted from this lot. So this will become 0, this will become 0. What remains in closing stock is 300 unit, which is this one, which is purchases. The second purchase made will remain in closing stock, and you will assume that these two have been sold. You will assume that these two have been sold. So goods which will be purchased or produced first will be sold first. Now this happens only in books, not in the actual go down. In actual go down, the movement of the goods will be depending on the convenience of the storekeeper. Is it right? In actual go down, FIFO may not be followed. Suppose this is the go down, this is the go down, long go down, okay, and you have kept the goods here on both sides. You have kept the goods, kept the goods, kept the goods, and now only this much space is pending. This is gate, and you have to issue the goods. Will you issue this good, which I will call A, or will you issue this goods, which is near the door, that I will call B? So student will answer, if I am following FIFO method in my go down, whether I am going to issue goods from A or goods from B, which is near the gate. This is the gate. Please reply fast to check your intelligence. Company is following FIFO method of inventory valuation, but in the go down, they will release B because it is near the gate. If they have to issue A, then first they will have to remove all these items. Oh my God. So if they have to issue A, first you have to remove all this, make space. And once the A is issued, again you have to put everything back. Again a new sale order will come. Again remove. Is it what you are going to do throughout the day? You will get tired. You will. One student, Saurav Jain, has said A will be issued first. Saurav Jain, I will make you the watchman or security guard of the store or storekeeper, and then you will realize what will be the problem. Suppose this is Saurav Chauhan. Saurav Chauhan, for a minute assume that you are the storekeeper here. To issue goods from A, you have to remove all these because there is no space. Again you have to put them back. Again you have to issue. That will waste your effort. FIFO is only on ledger or books. Actual movement in the go down will depend on the convenience of the storekeeper. What is next item? Weighted average cost. Weighted average cost means you will take the average cost based on quantity as well as price. Based on quantity as well as price. So the formula for weighted average cost per unit is opening stock value plus, those who want to write, purchase stock value divide by opening quantity plus purchase quantity plus purchase quantity. Student can write this formula. Sometimes they ask you question in the exam also. Okay. Saurav Chauhan is saying, sorry sir, I was telling in books only. Okay, no problem. Excuse accepted. Okay, so have you noted the formula? Here also we have two methods. There are two methods here. In weighted average cost, there are two methods. One is called perpetual method. After every purchase, weighted average rate is calculated. That is called perpetual. Or there is one more method called periodic. It means weighted average rate is calculated for a period. That means you don't have to calculate every time a new purchase is made. You will calculate the rate for a month or a year or a week. So that is called periodic. What you will do in the exam, you will do what is asked by the institute. If the question is silent, then you will follow perpetual method. If the question is silent, follow perpetual method. Tick mark. If the question is silent, follow perpetual method. Then that is called, after every receipt you have to calculate the rate. If you calculate once in a period, then it is called periodic method. So please write down one question. Write down one question which is not printed in your book. Please note down one question. Please note down one question for practice purpose. Mercury Limited. Mercury Limited uses a periodic inventory system. Underline periodic. Periodic inventory system. The following information. The following information relates to 20x1-20x2. Following information relates to 20x1-20x2, and then you draw this table with 5 columns. Little fast. Date, particulars, unit, cost per unit, and total cost. So in date column, write down April, May, September, and February. April, May, September, and February. Okay. And then you write down particular column inventory. This is opening inventory. Opening, OP. Opening inventory. Then purchase. Units means quantity. 200, 50, 400, 350. Total is 1000. Check the total, seems to be right. Cost per unit. Please write down the question in notebook. This is a good question for 4 marks in the exam. Waiting for being asked in the exam. 10, 11, 12, 14. 10, 11, 12, 14. Total cost 2000, 550, 4800, 4900. Noted? Then you write down one line, physical inventory at 31st March 2002 is 400 units. Physical inventory means closing stock is 400 units. Calculate ending inventory value. Calculate ending inventory value and cost of sale using FIFO or weighted average. Using FIFO or weighted average. So my dear student, try. Okay, time over. Anybody wants to answer? Anybody wants to answer? What is the answer under FIFO? What is inventory? What is cost of sale for FIFO method? Come on, you people are so intelligent. FIFO method you might have studied in costing also, maybe in foundation course also. So one student Tanya is saying 6750. What is 6750? Inventory or cost of sale? Kunal is also saying cost of closing inventory is 5500. Okay, FIFO, but there are two questions you have to answer. Tanya is saying under FIFO I got 6750. But please tell me 6750 is what? Cost of sale or inventory? One Mr. Arjun is saying 14,000 rupee. What is 14,000? Inventory value or cost of sale? The total inventory is 12,250. How can your closing stock be more than this? Nalayak. Those who said 14,000 something, today after the class is over, go to some nearby pond and take a dip. Okay. Cost of sale is 6750 and closing stock is 5500 by FIFO method. Okay, let me try now. You have tried enough. So first you write down FIFO inventory. I need to explain. Closing stock is 400. So it means this 350 is in the closing stock. And out of this 400, 50 is in the closing stock. This is sold, this is sold, and 350 units sold here. And what is in the closing stock? This 50 and this 350. So 50 into 12 I will do, and 350 into 14 I will do. That will give me FIFO inventory on 31st March 20x2. So please write down FIFO inventory, FIFO closing inventory on 31st March 2002. FIFO closing inventory value on 31st March 2002. Do the reverse working. Last 350 units is there in the stock at 14 rupees. Then before that, you have 50 units remaining multiplied by 12. So that gives me 5500. That gives me 5500. 5500. Total is 12,250. Shortcut now. If the total is 12,250 and 5500 is closing stock, remaining is cost of goods sold. Remaining will be cost of goods sold. So you can save time by taking it as a balancing figure. You can save time by taking it as a balancing figure. Okay. So solve yourself. Wait a minute. You try the weighted average now. Try weighted average now. Hang हो गया. Try the weighted average now. Okay, start. Now write down cost of sale. Cost of sale. Cost of sale is 12,250 minus 5500. 12,250 minus 5500. So that is equal to 6750. Let us move a little fast. Next line, write down weighted average cost per item. Weighted average cost per item. Weighted average cost per item 12,250 divided by 1000. 12,250 is the total cost. Total quantity is 1000. Total quantity is 1000. Therefore, the rate is 12.25. Weighted average inventory will be 400 into 12.25. 400 into 12.25. How much is 400 into 12.25? 4900. 4900. 4900. And cost of sale, Falak Mehta is right, 7350. Most of you got it right. It seems you have done costing material chapter very efficiently. This is called periodic weighted average rate because we have taken the entire purchases for a year and then calculated the rate. So this is called periodic weighted average rate. This is called periodic weighted average rate. So I hope you have understood. You can solve similar question in the exam and you will do similar practice in your cost accounting subject also. Okay? So if you have studied FIFO method and weighted average rate method in cost accounting, those questions are applicable today also. Enjoy. Now we'll come to technique for measurement of cost. Technique for measurement of cost. The standard says calculate cost based on actual data. Based on actual data. But if it becomes impracticable to calculate the cost, if it is impracticable, difficult, not possible to find out the actual cost, then the following method may be followed to ascertain the cost. Then you are given two more choices. But when will you come to this method? Underline, when it becomes impracticable to calculate the cost by the FIFO weighted average or specific identification method, then you can apply standard cost or you can apply retail cost method. These are based on approximation. These are based on approximation, not 100% accurate. So they should be avoided. But if you can't calculate the cost, then maybe they can be used. So it's written in the standard also. This method may be used for convenience if the result approximates the actual cost. So these are not good method, but can be used for approximation purpose. So one is called standard cost. Standard cost means predetermined cost. Standard cost means predetermined cost. Let us say this is this pen. So what I will do, I will prepare a standard cost. I will say this pen will require material 20 rupees. I will say this pen will require labor 10 rupees, other overheads 10 rupees. So I am saying my standard cost of manufacturing one pen is 40. At the end of there we have 1000 pen in the closing stock. So I will say the value is 40,000. So this is called standard cost, which is based on predetermined cost. That is cost which we have determined in my cost accounting department. My cost accounting department says that we think that the cost of manufacturing this pen would be so much. So instead of going into actual calculation, I take the standard cost. Okay. But when you are using standard costing, you have to be careful about the following things. Standard cost should be based on normal level of consumption of material and supplies. So one has to take normal conditions, not something like a pandemic condition, not something like when the factory does not work for 6 months in a year, not when there is a heavy inflation in material cost. So only normal circumstances, normal consumption should be considered, normal labor efficiency will be considered, normal labor cost, normal capacity utilization will be considered. Okay. Second thing, once you have calculated standard cost, if you have calculated standard cost in 2015, that does not mean you are going to apply in 2022 also. Every year you have to sit down and recalculate standard cost, because your cost can change over a long period of time. Either it can go up or it can go down. Okay. So therefore you need to keep revising your standard cost in the light of current condition. Good news, we don't have a question on standard cost. You will learn standard costing in your cost accounting subject. All those questions on standard costing is relevant for this topic, so we are not going to repeat the same thing here. Now next is called retail method. What do you mean by retail method? Retailers, have you ever gone to some retail store? Have you ever gone to some retail store? Tell me quickly. Have you ever gone to some retail store? So today you go to some retail store, some departmental store. Okay. Name some retail store which you go daily to buy your daily requirements. Please tell me. If you don't tell me, I will not give you the example. Any retail store which you go to buy your grocery, your soaps, detergent, household items, kitchen items. Okay, you go. Tiwari goes. Tiwari, where do you go? For buying chocolate. Oh my God. Don't eat chocolate. Your mind will not work. Body will become overweight. Tooth will decay. Sanket Jain goes to grocery store. Very good. Name your grocery store. Chaudhary ji. Oh. So if you see there are large number of items. There are large number of items. In fact, in some store, you have more than 10,000 items of different varieties, different color, shape, size. Okay. Then there are continuous movement of goods. Goods are coming in, goods are going out, customers are coming, and it is very difficult to maintain record. If it is difficult to maintain record, how will you apply FIFO, weighted average, etc.? So therefore one shortcut is given for such companies which are into retail. Okay, one person goes to S Mart, one goes to More, MORE, More. Then Kunal goes to AR Provision. Okay. My brother also has a grocery store. So his name is Balaji Bandar. Balaji Bandar. And then my another brother has another store. It is called Bajrang Bandar. Bajrang and Balaji are basically brother and cousins only. So my brothers have also kept the similar name. Okay, Balaji Bhandar, Bajrang Bhandar. So there are large number of customer. So my standard says do the reverse working. What is reverse working? In retail store there is something called MRP or selling price. Suppose MRP is 100 rupees minus your profit margin, minus your profit margin. Profit margin is suppose 10%. So mathematics, school level mathematics, selling price minus profit margin is going to give you the cost. Is going to give you the cost. If suppose you have multiple products with different margin, for example, this is let's say chocolate item, not much margin. Then you may have food items where the margin is 20%. All food items deduct 20%. Then suppose you have cosmetics. People are willing to pay lot of amount for getting a better updated face. So margin is more in cosmetic item. So that is cost is 50. Then shoes and chappal margin is even more 80%. So cost is 20. Is it right? So this way what a departmental or a grocery store can do, they will do reverse working. They will divide their products according to the margin, deduct the margin percentage, and then you will get the cost, right? So this is allowed only for retailers if they can't calculate the cost. Nowadays computers are available, advanced softwares are available. So therefore there is a continuous inventory updates. When you go to buy in some departmental store like you said More or S Mart, then there is a barcode reader. Have you seen that barcode reader? And there is a small machine kind of thing that is continuously updating their store ledger. So the moment you buy one chocolate Kit Kat, from their inventory, one Kit Kat stock will go down. So it is again, it has become an outdated method now because everybody maintains some kind of software to manage their inventory. And if you are using software to manage your inventory, then you can calculate the cost by FIFO or weighted average method, and then you cannot come to retail method anyway. So I have explained what was written. The formula under this method is selling price minus profit margin. A businessman will have to see what we do in our Balaji Bhandar stock on the end of the year. We will make a list of all the items that we have. Okay. So we have 10,000 items in our store. We will check what is their MRP or selling price. Then we will deduct profit margin minus profit margin, and then we will be able to find out the cost. Okay. So this way we can find out the cost in case of retail method. If more than one profit margin is there, then you can use multiple profit margin. Solve one example. Kindly solve question number 3 printed in your book. Selling price of an item in retail department is rupees 1000. The retail department uses a gross margin of 23%. What should be the value of the item? Selling price is 1000. Your profit margin is 25%. So your question is, how will you value this item? So you have to first find out what is its cost. The cost can be calculated by reverse working. The cost can be calculated by reverse working. Any query related to AS2? So Sanket Jain is saying 750. Tanya 750. Who else? Kunal 750. Very good, Kunal. Sakshi 750. So the answer is 750. Right answer. 750. 1000 minus 25%. 1000 minus 25%. Okay, 1000 minus 25% is your answer. Come on. Now, after so much of hard work, we have learned cost. What we have learned in cost calculation? We have learned in cost calculation cost formula and cost techniques. Quickly revise. Cost formula, there are three: specific identification method, FIFO method, weighted average. Cost technique, there are two: standard costing and retail method. Okay. Cost will comprise of material, labor, direct expense, variable production overhead, and fixed production overhead. Okay. Material, labor, direct expense and variable, these are based on actual. Fixed production overhead is based on actual or normal, whichever is higher. Whichever is higher. That is the summary of our discussion in 10 seconds. Now we'll come to second element of our discussion, that is NRV. The golden rule of this chapter is inventory will be valued at cost or NRV, whichever is lower. So NRV means reverse working again. This is my selling price in normal course and I have to do reverse working and find out what is NRV. So I will deduct certain things. I will deduct from this any cost required for completion, cost to complete. I will deduct cost to complete and I will also deduct any cost necessary to complete the sale. Any cost necessary to complete the sale. Some example we have taken earlier, like for example transport cost. If you have to give home delivery to the customer, nowadays there is a concept of COD, cash on delivery, or home delivery. When you purchase our Google Drive and Pendrive, we give books to you at your home. There is a cost involved, that is called cost necessary to make the sale, and cost to complete means any further processing cost. Any further cost that will go in completion to complete the goods. So reverse working, if this is 100 rupees, this is 10, this is 5, what I will get in my pocket is called 85 NRV. Okay. Next point. How do you calculate NRV? NRV is based on the most reliable evidence available at the time the estimates are made. So it should be based on most reliable evidence. For example, it will be based on your sales catalog price on balance sheet date. Or the other example could be uh, invoice value around balance sheet date. Invoice value around balance sheet date can be the estimate of NRV. For example, you come to our shop on 31st March 2023, example, and you say, I want to buy a calculator. I will say calculator is 125 rupees. So this is one of the best evidence of NRV. To calculate NRV, I know that on 31st March I was selling this item for 125 rupees, or at least every businessman has a price catalog. That is, this is the price at which it is sold in the market. Okay. Every balance sheet date, every year, you have to calculate NRV. If I have calculated NRV in 2019, it is not relevant in 2023. I have to check again, because every year the selling price can change. So NRV has to be estimated fresh every year. The basic theme of this chapter is cost or NRV, whichever is lower. Now, if I have many items in my closing stock, how do I compare? So, I will compare preferably, first preference is item by item. First preference will be item by item, but second preference is group of items. Second preference, second preference is group of item, but I will not apply global basis. Okay, global basis means overall total, overall cost. Overall cost will not be compared with overall NRV. Now, what do you mean by item by item? What do you mean by item by item? Now, see, this is item by item example. So, in your book, I have given this table, blank table. So, the student who have the book in front of them will do this problem question 4 in your book. A company has 5 items. A, B, keep writing C, D, E. A company has 5 items A, B, C, D, E. Then their NRVs are given 26,000, 42,000, 15,000, 32,000, 26,000, and total is 1,41,000. And the cost is given to you 22,000, 45,000, 12,000, 28,000, 27,000. And I have done the totaling also for you, is 1,34,000. 1,34,000. 1,34,000. Now, if you have to compare item by item, it means what you will do, compare these two. Compare these two. Take the lower figure. Why we take lower? Prudence concept. So please reply, what will be the value of A for balance sheet purpose? What will be value of A for balance sheet purpose? Tell me, what will be value of A for balance sheet purpose? Lower of the two. 22,000. Very good. For B, lower of the two. 42,000. For C, for C 12,000. For D, come on, for D, lower of the two, 28,000. And for E, lower of the two, 26,000. E 26,000, and tell me the total. The total comes to 1,30,000. Total comes to 1,30,000. Total comes to 1,30,000. This is called item by item comparison. This is the first preference. This is the first preference. Okay. Do not compare the total. If you compare the total of all items, NRV, and total cost of all items, that is called global approach, and your answer will be 134, which is wrong. Why it is wrong? If you apply global approach, sometime the profit of one item will compensate for the loss of other item. You can see in C, there is a 3,000 rupees profit, whereas in case of B, there is a 3,000 rupees loss. So if I take their total, the loss is compensated by gain. So indirectly you are recognizing some gain. Indirectly, if you compare only the total of the two columns, indirectly you are recognizing the gain on item C, and you will not get the lowest value. So therefore, to be more prudent, better you should take item by item, and this will go to balance sheet. This 1,30,000 will appear in balance sheet, the lowest. So item by item will give you lowest value. The logic of item by item is it will give you lowest value. Prudence concept. Item by item gives lowest value. Bracket prudence. Anticipated loss should not be recognized. Anticipated gain should not be recognized. Anticipated loss can be recognized. Now next important topic is valuation of raw material or supplies. What is the golden rule of this chapter? The golden rule of this chapter is cost or NRV, whichever is lower. But yesterday I have told you there are some exception. There are some exception, and when these exceptions are applicable, then I will not apply cost or NRV, whichever is lower. Either I will take cost or I will take NRV. Either I will take cost or I will take NRV. Okay. So one such exception is applicable to raw material. One such exception is applicable to raw material. Now what is the purpose of holding raw material? What is the purpose of holding raw material? Okay, suppose we buy papers. Let us say these are the papers we have purchased. Okay, paper. And what is the purpose of buying this paper? We'll prepare a small book like this. Okay, small book, only 500 kg. Sorry, 5 kg. If all these pages will be compiled, it will become 1,000 pages. So, what is the purpose of buying paper? Paper is raw material for us that is used in manufacturing books. Books will be sold. Now, books after manufacturing can be sold at cost, above cost, or below cost. Possible? Say yes or no. Paper is raw material. Paper is used to manufacture books. I don't trade in paper. I don't buy and sell paper. I use paper to manufacture books. I use paper to manufacture books. Then the standard says, look at what will happen to the book. Look at what will happen to the book. The book will be sold. At what price? At cost, above cost, below cost. Now the standard says, listen to me carefully because you are going to ask me question later. If paper is going to be used for manufacturing of books and book is going to be sold at or above cost, at or above cost means no loss. At or above cost means no loss. No loss means your cost is recovered. No loss means cost is recovered. If your cost is recovered, then in that case, even if paper NRV is lower, ignore. Even if NRV of paper is lower, ignore, because paper is going to be used in manufacturing of books. Books will be sold at cost or above cost. So there is no need to value paper at NRV. Even if NRV goes down, the logic is I am not going to sell the paper. If I am not going to sell the paper, I am not going to suffer the loss. I am going to use the paper for manufacturing book. Book will be sold at or above cost. So this is one exception. This is one exception to general rule, and that is about raw material. If raw material is used in finished product, finished goods will be sold at or above, then an RV of the raw material or supply is considered at its cost only. In short, raw material will be valued at cost. Raw material will be valued at cost. There is no need to write down, the raw material cost. No need to write down the raw material cost because I am not going to sell the raw material. But there is another possibility that this raw material paper is going to be used in manufacturing of books and books will be sold below cost. Below cost means loss. Loss means your cost is not recovered. Cost is not recovered. That is loss. What is loss? Loss means you can't recover your cost also. So if your cost is not recovered, then in that case, you may, not must, you may reduce the value of raw material. If finished product in which raw material or supply is used is sold below the cost, raw material or supply is written down to its NRV. Now NRV here means net replacement price. R stands for replacement. So what is the difference between realizable value and replacement value? Realizable value means amount you will realize when you sell. Replacement value means amount you will get or amount you will pay when you buy. When you buy, how much you will pay. And realizable value means how much will you get when you sell. Raw material is not sold, raw material is purchased. Okay, so this is the logic. One small exception you have learned today, exception which probably you were not aware. Your foundation or 12th standard teacher must have always said cost or NRV whichever is lower, but now you should know if raw material is used in finished goods is sold at or above cost, then raw material will be valued at cost. then raw material will be valued at cost. No need to write down raw material value. Okay, so to make my point further clear and easy to understand, this flow chart will help you. Drawn in your book also. Before that, note down homework. Question 5, question 6, homework. You will do it in the notebook. Everybody, stock of raw material. So check the purpose of holding the raw material. Usually raw material is used for production, but sometime by mistake you may purchase excess quantity. I need to manufacture 100 books, but I have purchased paper of 110 books by mistake. Some extra we purchase so that there is no shortage in the last minute. So I am going to sell those 10 units and I am going to use 100 units in manufacture of books. Is it right? Now once you are here, check at what amount finished goods will be sold. If finished goods for which raw material will be used will sell at or above cost, then the raw material will be valued at cost. Raw material will be valued at cost. Then no need to write down. But if finished goods is going to be sold below cost, that means finished goods will be sold at a loss, then I will apply my general knowledge, general principle, lower of cost and NRV. For excess quantity, that is those quantity which I am not going to use myself but I am going to sell it because it is excess, I will again apply the golden rule of this chapter, cost or NRV, whichever is lower. Now, in order to understand the concept better, we will take one example. Question 7 in front of you, and there is one tricky issue which is going to come. So please pay attention. One tricky issue is going to come in this problem. All of you are ready. All of you are ready. Tighten your belt. We are going to take off. A raw material costing 150. So what is the cost of raw material? 150. Has NRV, net replacement value, 130. So its NRV has gone down. But that does not mean you are going to reduce raw material necessarily. One has to see what happens to the finished goods. The finished goods for which the raw material has other cost to incur is 60. Other cost is 60. So what is the cost of finished goods? Please answer. What is the cost of one unit of finished goods? 150 is raw material, 60 is other cost. So what is the cost of finished goods 1 unit? First you answer that query. 150 plus 60. Come on, 150 plus 60. Very good. 210. Cost of 1 unit of finished goods is 210. Is it right? Cost of 1 unit of finished goods is 210. So now you have started answering. Very good. Question continues. At what price? At what price raw material should be valued if the finished goods has an NRV? If the finished goods has an NRV of 210 or above, second question, less than 190, and third is 200. So dear student, you will now participate in answering this question. Okay. Raw material cost 150. Other cost 60. cost of 1 unit of FG, finished goods, is 210. Case 1, the NRV of finished good is 210 or above. This is my case A. So the question is, at what amount raw material will be valued? At what amount raw material will be valued? At what amount raw material will be valued? Come on. So students have started answering raw material will be valued at cost, because if finished goods is going to be sold at or above cost, so there is no loss in finished goods. If there is no loss in finished goods, it means your entire cost is recovered. So the answer for first part will be raw material will be valued at cost, that is 150, because there is no point in reducing the value of raw material. Raw material will be used in finished goods. Finished goods will be sold at a profit. So you are not going to lose anything. So 150. Is it right? Now I will change it to case 2. Now I will change it to case 2. Case 2 says raw material will be used in manufacturing finished goods, and finished goods will be sold below rupees 190. So there will be a loss of 20 or more. There will be a loss of 20 or more. My question is, raw material cost is 150 or NRV of raw material is 130. What will be the value of NRV to be reported in the balance sheet? What is the value of NRV to be reported in balance sheet? Case B, on finished goods we are going to suffer loss of 20 rupees or more than 20 rupees. Less than 190 means either the loss will be 20 or more than 20. If it is 160, we will have a loss of 50 rupees. So what is the answer for this case? Yes, if the loss is going to be 20 rupees or more, in case of raw material also, the reduction in the value is by 20 rupees. And the reduction in finished goods is also 20 or more. It means you are not able to recover the cost of raw material fully, and therefore the answer for this will be raw material will be valued at 130. So it can't go below 130 because that is the replacement cost of raw material, 130 rupees. Is it right? And now my next question is, if finished goods is sold at 200 rupees, if finished goods is sold at 200 rupees, please answer now. Finished goods can be sold for 200 rupees. At what amount raw material will be valued for balance sheet purpose? This question is important. What is the cost of finished goods? 210. What is the NRV? 200. So what is the loss you are incurring on finished goods? You are incurring a loss of 10 rupees on finished goods. That means 10 rupees you are not able to recover. You are not able to recover 10 rupees. So if suppose this raw material is used in manufacturing finished goods, you will recover 200 rupees. Suffer loss of 10. Out of this 200, 60 is other cost, which means 140 of raw material you are able to recover. 140 of raw material you are able to recover, right? So in this case, my answer will be raw material will be valued at 140 because I am able to recover 140. I am able to recover 140. Sakshi, Saurav, you are right. Kunal is right. Okay. We are able to recover 140. Third question was tricky. In third question, many students were thinking, since finished goods is sold below cost, I should take 130 as an answer. So the answer is no. Suppose for practice purpose, we'll take one more example. For practice purpose, suppose the question says finished goods will be sold at 209.90 paise. 209 rupees and 90 paise. Okay. Okay. Now my question is, at what amount raw material will be valued? If finished goods will be sold for 209.90, it is below cost. But how much is the loss here? 0.10 only. The loss is 0.10 only. Do you think that for 10 paise loss, I will reduce the raw material value by 20 rupees? For 10 paise loss in finished goods, do you think I will reduce the value of the raw material by 20 rupees? The answer is no. So the answer for this question would be raw material will be valued at 150 minus 0.10 loss that cannot be recovered. So 149.90. Kunal is right. Tiwari, Sanket, 149.90 is right. Okay. So do you want to write the answer or answer is written? The answer is already written in your book. First answer is written. There is no need to write down inventory of raw material. Raw material will be valued at 150. Second answer is written as the NRV of finished goods is less than its cost 210. Raw material will be valued at 130 because here the loss is more than 20. Loss in FG is more than rupees 20. But if the loss is less than 20, I will only deduct the loss from the cost of raw material. The finished goods is sold rupees 10 below the cost. The raw material will be valued at 140, 150 minus 10. 150 minus 10. So what is the uh, golden rule here for raw material? Golden rule for raw material is loss on raw material or loss on finished goods, whichever is lower, whichever is lower will be deducted from cost of raw material. Whichever is lower will be deducted from the cost of raw material. If in finished good the loss is only 10 paise, then only 10 paise will be deducted. But if on the finished good the loss is 30 rupees, but loss on raw material because of reduction in its value is 20, then I will deduct only 20. In any case, I will not deduct more than 20 from the cost of raw material. In this example, in any case, I will not deduct more than 20 rupees from the cost of raw material. So this is about raw material. Okay. And when you will do the practice of question number 8, let us practice one more question. Question number 8 is there. We'll practice together in the classroom. Okay. Raw material cost is 90, labor 390, 30. Total cost of finished goods is 420. This kind of questions are asked for 4 marks in the exam. If you don't know the concept, you will make mistake. At the end of the year, the firm has 1500 units of raw material which are to be valued for financial statement. Current replacement cost of raw material is 280. So its replacement value is 280. So there is a reduction in the value of raw material by 20 rupees. The raw material value has gone down by 20. I will not reduce it below 20 in any case. But if the loss in finished goods is less than 20, then I will reduce the loss in finished goods only. If the loss in finished goods is going to be more than 20, I am going to reduce only 20. Find out the value of the raw material inventory if the selling price of the finished goods is 450. So answer for this case is finished goods is sold above cost. If finished goods is sold above cost, raw material will be valued at cost, that is 300 rupees. If finished goods is sold above cost, our raw material will be valued at cost only, that is 300. So this is the exception to the general rule that cost or NRV, whichever is lower. In this case, raw material will be valued at cost. Now come here. It says finished goods will be sold at 300 rupees, 390 rupees. So the loss on finished goods is 420 minus 390, that is 30 rupees. But the reduction in the NRV of raw material is only 20 rupees. So the answer is raw material will be valued at 280 rupees. It can't go below 280. It can't go below 280. Is it right? So I have taken these two questions on raw material. There are some more questions which you will practice. Okay? Any query on this? So once you get the answer, you multiply by 1500 quantity. So first answer will be 1500 into 300. Second answer will be 1500 into 280. The answer is printed in your book, you can just check. Next concept is called inventory held to satisfy firm sales or service contract. Inventory held to satisfy firm sales or service contract. What do you mean by this? This is Mr. A. This is Mr. B. Who is Mr. B? Customer of Mr. A. What they have entered into an agreement? They have entered into a contract. What is the contract? A will supply to B. A will supply to B goods at rupees 100. How many quantity? 1000 quantity. When? After 3 months. A will supply to B. A will supply to B 100 units, 1000 unit at 100 rupees after 3 months. So now what is the issue? A has a closing stock of 2000 unit. closing stock lying with A is 2000 unit. The cost is the cost is 120 rupees. The cost is 120 rupees per unit. Market value market value for other customer is 140 rupees. But with respect to B, it is 100 rupees. You have entered into a contract. Out of this 2000 unit, out of 2000 unit, we have to supply to Mr. B 1000 quantity, and we have to supply to other whosoever wants to buy others. So I can sell others 1000. Now what this standard says, these 1000 quantity are specifically for Mr. B. So here you apply cost 120 and agreed price with Mr. B 100 rupees, and therefore the inventory will be valued at lower of the two, that is 100 rupees. As far as others are concerned, that is which I am going to sell in the market in future, cost is 120, market price is 140. So here I am going to value inventory 120. So 1000 unit which is meant for supplying to B will be valued at 100 rupees, and the remaining 1000 unit will be valued at 120 rupees. Remaining 1000 will be valued at 120. So in case if you are holding some inventory to be supplied against a firm contract, firm means agreement, contract, you have entered into a contract that this 1000 unit will go to Mr. B only at 100 rupees, but the cost is 120. So I will apply for this 1000 quantity which is to be sold under a firm contract at cost or that contracted price, whichever is lower, and for the remaining quantity I will apply AS2 as usual. So there is a note which says the estimate of NRV also takes into consideration the purpose for which the inventory is held. So while calculating NRV, one has to also see the purpose for which the inventory is held. If it is held for supplying under a firm sale contract, then that firm sale contract price will be considered for estimating NRV. So see one example printed in your book. Example is like this. Stock of A 5000 unit, cost is 50. This cannot change, this is fixed. Out of this, 3000 units are to be supplied under a firm contract. So here I will compare 50 with contract price 45. The general price is 49. Remaining 2000 I will apply cost 50 and general price level 49. So my question to this batch of highly intelligent and talented student is, what will be the value of closing stock? For 3000 unit, I will take 45, lower of the two, and for 2000 unit, I will take 49, lower of the two, and therefore the answer would be 5000 inventory unit will be valued at, come on, at what rate? The answer is it will be valued at, total amount will be 2,33,000. Check the answer. First 3000 quantity will be valued at 45. The remaining 2000 quantity will be valued at 49. So that makes it 2,33,000. Okay, I will change the example now. In the above example, if the general price is 52, how valuation will be done? So I have 5,000 unit, 3,000 unit, 2,000 unit. Here my cost was 50 and the contracted price is 45. Here my cost is 50, but the market price, general price is now they're saying 52. So my question to this batch of highly talented students is, what is the value of inventory? Come on, try fast. This 3,000 unit will be valued at 45 and these 2,000 units will be valued at lower of the two, cost 50 rupees. Therefore, the answer would be, the answer for this question will be, come on, Kunal, Sakshi, 2,35,000. Kunal and Sakshi are two persons. Okay. Satish, Triambakam Tiwari. Triambakam Tiwari is one person only. The name is equivalent to a small address in Nepal. Now come to example 3. In the above example, if the firm contract is to supply 8,000 unit, how many units do I have in my stock? 5,000. Contract is to supply 5,000, contract is to supply 8,000. So I will value the entire stock, cost 50, contracted price 45. Entire 5,000 unit will be valued at 45. Entire 5,000 unit will be valued at 45. But you have to supply 8,000. 3,000 units I don't have in the stock. So this 3,000 unit will not come in the closing stock. However, because the cost is 50 and selling price agreed is 45, there is a potential loss. There is a potential loss equal to 3,000 into 5 rupees, and we will make a provision for loss. This is given in AS 29. This is given in AS 29. So the answer is, inventory will be valued at 2,25,000, 5,000 into 45, but at the same time, this contract will result into a loss. So AS 29 applies, and AS 29 says you will have to create a provision for loss of rupees 15,000 rupees, 3,000 into 5 rupees potential loss. But AS 29 right now we will not discuss in detail. Maybe in the exam you can just close your answer by writing the entire stock will be valued at 45 rupees per unit, and that is equal to 2,25,000. That is equal to 2,25,000. One last discussion for today. Okay, just 2 more minutes. Valuation of joint product. What is joint product? Have you heard joint product? Input 1, and it may give rise to more than one type of product. Joint product 1, joint product 2, and sometimes it may give rise to byproduct also, scrap also. Possible? Say yes. So all of you are interested in learning, right? Should I continue for 5 more minutes? Say yes. Yes. All of you agree 5 minutes more? So now what we will do? First we will calculate total cost. This is called joint cost. Okay, this is called joint cost. Like in sugar industry, it happens. You get sugar and molasses. In crude oil industry, it may happen. You may get diesel, kerosene, petrol. So what I will do, first I will calculate joint cost. From that I am going to first deduct two items. Which two items I am going to deduct? NRV of scrap. Scrap means very low value, but there is some value, not zero, and I am going to deduct NRV of byproduct. These two items are again exception. Byproduct and scrap will be valued at NRV because we can't calculate their cost. Simply we will check how much amount we are going to realize, how much amount I am going to realize by selling the byproduct net of any expense, NRV. How much amount I am going to realize by selling the scrap net of expense, NRV. So these two items are again exception to this chapter. This chapter says cost or NRV whichever is lower. In case of byproduct and scrap, I can't calculate the cost. So I will take at NRV, net realizable value, that will give you cost attributable to joint products. Joint products are main products. They have significant economic value. They are intentionally produced. Byproduct and scrap are not intentionally produced, but they get produced in the process of production and they have some value. So therefore we are discussing. Now this cost needs to be allocated. This cost needs to be allocated over joint products. In which ratio? The standard says sales ratio. The standard says you will allocate in the ratio of relative sale value. The standard says you will allocate them in the ratio of relative sales value. Okay. So this is about joint cost and byproduct. Now we will continue on Monday. Now we'll continue on Monday because there is a problem which will take some time to solve, and I am going to take a very important bigger question also. Then I will take a comprehensive question which will make your total understanding clear. So next lecture of accounting standard will be on Monday. Enjoy your Sunday. Okay. Bye bye. Thank you.